The S&P 500 is 40% overvalued. Tech giants dominate 40% of the index, while thousands of quality companies trade at fire sale prices. What if I told you there are profitable S&P 500 stocks trading at PE ratios below 9? That's like buying a Rolex for the price of a Casio. Today, we hunt for deep value gems hiding in plain sight. These aren't risky penny stocks. They're household names with strong cash flows, dividend yields, and moat to unlock massive upside. Let's dive. Why deep value now? Value investing has underperformed for 15 years until now. Rising interest rates, AI hype fatigue, and extreme market concentration are creating a historic opportunity. The S&P 500's top 10 stocks weigh more than the bottom 300 combined. When value stocks rebound, they explode. Post-2000, value outperformed growth by 200% in 5 years. Why? Market overreaction. Investors dump boring stocks for shiny tech, ignoring fundamental metrics like PE ratios, free cash flow, and debt levels. We're sifting the S&P 500 using 3 value investor filters. 1 PE under 9 versus S&P's 24.2, 2 strong free cash flow, lifeline in recessions, 3 moat. Here are the 4 deep value gems. 4. Altria, MO. 3. United Airlines, UAL. 2. Ford. 1. APA Corporation, APA. Gem 4. Altria, MO. The sinful cash cow Wall Street calls this a dying sin stock. They're missing the $8.6 billion cash machine ding in plain sight. The contradiction, cash tsunami and cigarette crash. Let's rip off the Band-Aid. Cigarette volumes are collapsing. Shipments down 9.7% last year. But here's the dirty secret Wall Street ignores. Altria prints cash anyway. Check these financial metrics. Profit margin, 50.44%, double apples. Operating cash flow, $8.6 billion a year, funding that monster dividend. PE ratio, 9x, trades like a bankruptcy candidate. Dividend aristocrat, 54 straight years of payout hike. Moat, nicotine isn't just addictive, it's Altria's secret weapon. Switching costs? Brutal, 90% quit attempts fail, biology traps customers. Marlboro, 45.7% market share, number 1 for 50-plus years. Premium brand loyalty, smokers pay 20% more. FDA approval takes 5-plus years. Blocks new rivals. Flavor bans and marketing bans freeze small players out 2 metal plus per product application. Only giants can play 230,000 retail outlets, gas stations, convenience stores. 70% of stores have 2 tobacco options. Marlboro always wins. 3 existential threats. No fortress is impregnable. Altria's risks keep investors awake. 1. Enjoy import ban, March 2025, could cripple vape growth. 2. $26 billion debt bomb, interest coverage slipping to 5.9 bikes. 3. Cigarette volume free fell, 4.2% revenue decline last quarter. This is a compounding machine. Reinvest dividends 20 years, you'd collect $1.2 million from a 100K start. No stock growth needed. Yes, tobacco is declining, but Altria's PE of 9 and 9.2% dividend make it a cash fortress. Gem 3 United Airlines, UAL, the travel bet Wall Street thinks United Airlines is just another dying legacy carrier. They're dead wrong, because UAL built 3 invisible moats while nobody was looking, and they're about to unleash a cash flow tsunami. While rivals bled, United delivered. $18.3 billion liquidity, enough to buy Spirit Airlines twice, 20% free cash flow yield, $5 billion generated in 12 months, ROE of 26.18%, smoking deltas 16%, forward PE of 6.83x, trading like a bankruptcy candidate, not a profit machine. The moats, United's secret weapons, Chicago hub dominance, 22-point market share lead, like Apple versus a flea market phone. Mileage plus nuclear reactor, $1.5 billion quarterly revenue, up 9%, bigger than Bolivia's GDP. Credit card surge, 100% growth in Denver, Chicago, customers paying UAL to access their money. Polaris premium cabins, RASM up 8%, rich travelers don't care about inflation. Basic economy, price-sensitive millennial, covered. International chokehold, slot-controlled airports equals no new competitors for 20-plus year. Axe off peak flights, slashed pre-7 a.m., post-8 p.m. routes, 40% revenue gap versus peak. Retired 21 gas guzzlers, saving $225 million a year by 2027. CASMX up just 0.3 cent, while fuel soared 20%. This is cash flow disguised as an airline. 2 and 28 byte quarterly operating cash flow funds buybacks for years. Gem 2, Ford F, the EV dark horse. Wall Street wrote off Ford as another dying ice dinosaur. They're dead wrong. Why? Because Ford built 3 invisible moats while nobody was looking. Let's rip off the Band-Aid. While Tesla bled, Ford's cash engine purred. $29.6 war chest, enough to buy Rivian twice 6x PE ratio, trading like a bankruptcy candidate, not a profit machine, 5.88% dividend yield paid from $3.5 FCF, 26% ROE, smoking GM's 16%. The invisible moats, Ford's secret weapons. Ford Pro isn't just selling vans, it's printing money. 15.2B Q1 revenue, 16% of Ford's total, 40% market share in commercial software, locking fleets into subscriptions, 20% gross margins, double the industry average. F-Series dominance, 45 years as America's #1 truck, 250K Lightning reservations. Ford didn't abandon gas, it weapon-Z'd it. 97% truck SUV sales mix, ditching sedans to focus on profit kings. $7.6 R&D war chest, funding EVs while ICE profits roll in. Mach-E instantly profitable, unlike Rivian's $6 losses. 70% Lightning buyers new to Ford. Stealing Tesla-owned 3,100 U.S. locations, service centers within 10 miles of 90% of Americans. $0 marketing cost. Dealers spend billions locally. Ford saves cash. Deep value math, why this could 5x loyalty program alone worth $20 more than Ford's market cap. Ford Pro valued at $120 if spun off like Ferrari, $1 per year warranty cuts, fixing quality issues, crushing margins. Ford isn't a relic, it's a cash-fueled rebellion. 5.88% dividend yield, paying you to wait. 3 unbreakable moats. Pro, dealers, ICE profits, $45 intrinsic value, 275% upside potential. Recession-proof, $7 EBIT floor even in 2008 style crash. Gem 1 APA Corporation, APA. What if I told you Wall Street is sleeping on a $6 billion treasure buried in plain sight? A stock trading at just 6x earnings, paying a 5.88% dividend yield, and sitting on assets that could supercharge your portfolio. Check these financial metrics. Market cap, just $6.4 billion, smaller than most Permian pure plays. PE ratio, 6.09x versus industry average of 10x plus. Price book, 1.3x, meaning you're paying barely over asset value. Free cash flow, $2.28, funding dividends and debt reduction. Operating cash flow, $4.35 per year. Dividend machine, 5.88% yield plus 36% payout ratio. Sustainable even at $50 oil. The moats, why APA isn't just another oil stock. Global diversification. Permian Basin, 125K barrels day oil plus 800K well cost savings. Egypt, renegotiated gas prices, 55.2% EBA margins. Suriname, massive offshore discovery, FID on Grand Morgue Fa. The risks, why bears hate this stock. No gem is flawless. APA's risks are real. Debt, 549 total debt, 85% debt equity, though down from 262% in 5 years. Geopolitics, Egypt receivables, Suriname development risk. Short attack, 40M shares shorted. Betting it crashes further. This is a cash-generating machine trading like a junk bond stock. When the market wakes up, boom. These aren't get-rich-quick memes. They'd war-tested businesses trading below liquidation value. Like if you found stock number 3 surprising, comment your favorite value stock, I'll respond. Subscribe for our Value Investing Resurgence series.